It's a Wednesday evening. Marcus sits at his kitchen table, laptop open, paying bills like he does every month. Mortgage payment, auto pay, done. Car insurance, handled. Everything looks fine. Same as last month. Same as the month before. Then he opens an email from his insurance company. His homeowner's policy is up for renewal. Last year he paid $2,400. This year they want $4,200. He checks his escrow statement. There's a shortage. His property taxes increased because his home value went up on paper. The county reassessed the whole neighborhood. Now his lender wants an extra $387 per month to cover the gap, starting next month. Marcus hasn't missed a payment in 6 years. He hasn't changed jobs. He hasn't done anything wrong. But suddenly, his housing cost jumped by $600 a month, and nobody warned him it was coming. He's not alone. Right now, 86.67 million Americans carry mortgages totaling $13.07 trillion. That's $13 trillion. And what most people don't realize is that the mortgage payment is just the beginning. Americans are also sitting on $422 billion in home equity lines of credit. They took out that money when rates were low and home values were climbing. Now those variable rate payments have nearly tripled. In November 2025, the national mortgage delinquency rate hit 3.85%, a 4-year high. That's 2.3 million homes with owners who have fallen behind. But here's the part that should get your attention. In a single month, October to November, 275,000 borrowers who were current on their payments became delinquent. That's the largest one-month spike since May 2020 when the economy shut down. This isn't a crash, not yet. It's something slower, a pattern that's been building for 20 years, a pattern that has destroyed millions of American families before. And if you own a home or plan to buy one, what happens over the next 18 months will determine whether you keep your wealth or become part of the largest financial transfer in modern history. Let me show you exactly how this works. Because it's happened before. Every single time people said it was different. Every single time they were wrong. Here's what nobody tells you about housing crises. They don't happen randomly. They don't come out of nowhere. They follow a pattern. The same pattern. Every single time. I've spent months studying every major housing crisis in American history. The 1990 collapse, the 2008 meltdown, the regional disasters in between. And what I found is that they all follow 4 distinct stages. Miss one stage, you might get lucky. But when all 4 stages line up in sequence, the outcome is always the same. Stage 1, cheap money. It starts with low interest rates. The Federal Reserve cuts borrowing costs to stimulate the economy. Mortgages become affordable. Credit flows freely. Banks compete to put people into homes. The whole financial system is designed to get you to borrow. Stage 2, the equity illusion. Home prices rise, sometimes slowly, sometimes fast. Your house appraises higher than what you paid. On paper, you just made money. Banks send you letters. Stage 3, the cost shock. This is where the trap closes. Interest rates rise. But that's not the real problem for most homeowners. The real problem is everything else. Property taxes go up because your home value went up. Insurance premiums spike. Utilities climb. Maintenance costs increase. If you have any variable rate debt, those payments jump too. Your income stays flat. Suddenly you're spending 30, 35, 40% of your paycheck just to keep the house. Stage 4, the avalanche. Individual struggles become systemic crisis. Homeowners who can't keep up try to sell, but buyers can't afford current prices at current rates. Homes sit on the market longer. Desperation sales begin, prices soften. Then the math turns brutal. If you bought near the peak, you might owe more than your home is worth after closing costs. You can't sell without bringing cash. You can't refinance because rates are higher. You stop paying. Foreclosures rise. More inventory hits the market. Prices fall further. The cycle feeds itself. Think of it like dominoes. Cheap money sets them up. Rising prices spaces them out. Cost shocks push the first one. And once they start falling, they don't stop until they run out of dominoes. This pattern destroyed 9 million American families in 2008. It wiped out $16 trillion in household wealth. So it took a decade for some markets to recover. And right now, in January 2026, we are watching stages 3 and 4 begin to overlap. I'm going to prove this to you. First, I'll show you how this exact pattern played out in 2008, so you can see the mechanics. Then I'll map current data to each stage so you can see precisely where we are today. And finally, I'll show you what's likely coming and what you can do about it. Let's start with what happened last time. Let me take you back to 2001. The dot-com bubble just burst. The September 11th attacks shook the economy. The Federal Reserve needed to prevent a recession. So they did what central banks do. They cut interest rates. By June 2003, the federal funds rate hit 1%, the lowest in decades. Mortgage rates dropped to 5 and 6%. After years of rates above 8%, this felt like free money. Stage 1 was in full swing. Here's what happened next. Between 2001 and 2006, banks went on a lending spree. Mortgage originations exploded. Subprime loans, mortgages given to borrowers with weak credit, went from 8% of the market to 20%. Lenders created products designed to get people into homes regardless of whether they could actually afford them. Interest-only loans, adjustable rate mortgages with teaser rates that reset after 2 years, no-doc loans where you didn't have to prove your income. The industry had a term for one type of borrower, ninja, no income, no job, no assets. If you could fog a mirror, someone would give you a mortgage. Now let me show you what this looked like on the ground. In 2004, a young couple in Phoenix, call them David and Rachel, bought their first home. $180,000. They put down 5%. Their combined income was $65,000. The mortgage broker got them into a 228 adjustable rate loan. 2 years at a fixed 4.5%. Then it would reset to market rates. Monthly payment, $800, manageable. They figured they'd refinance before the reset. Everyone was doing it. Home values only went up. The broker told them so. Stage 2 kicked in hard. Between 1997 and 2006, median home prices rose 124% nationally. In Phoenix, prices nearly tripled. That $180,000 house David and Rachel bought? The offers started arriving. Credit card applications, home equity lines, cash out refinance deals. One company sent them a check for $25,000 they could deposit immediately. They took out a $40,000 home equity line, new furniture, a second car, credit card payoff. The payments were low because rates were low. Meanwhile, Wall Street turned these mortgages into gold. Banks bundled thousands of loans together into mortgage-backed securities and sold them to investors worldwide. Pension funds bought them. Foreign governments bought them. Everyone wanted a piece of the American housing market. The ratings agencies, Moody's, Standard & Poor's, Fitch, stamped AAA ratings on packages stuffed with subprime garbage. They were getting paid by the same banks creating these products. Nobody asked hard questions. The money was too good. By 2005, it seemed like everyone was a real estate genius. Your neighbor bought a condo, flipped it in 6 months, made $50,000. People quit their jobs to become full-time house flippers. In Arizona, Florida, Nevada, and California, investment purchases jumped from 25% of sales in 2000 to nearly half of all transactions by 2006. Then came the turn. In 2006, home prices peaked. Most people didn't notice. Sales slowed a little. Inventory crept up. No big deal. But inside the financial system, cracks were forming. Here's a detail most people never learned. The crisis didn't start with foreclosures. It started on trading desks. There's an index called the ABX. It tracks the value of bonds backed by subprime mortgages. In early 2007, it started falling. By October 2007, it had crashed 60%. The bonds that Wall Street had stamped as safe investments were revealed as toxic. Banks looked at their balance sheets and found billions in assets they couldn't price. Not worthless, just impossible to value. When you don't know what something is worth, you can't sell it. When you can't sell it, you can't raise cash. When you can't raise cash, you can't lend. Credit markets froze. Banks stopped lending to each other overnight. The entire financial system runs on overnight lending. When that stops, everything stops. Stage 3 hit American households like a freight train. David and Rachel's adjustable rate mortgage reset in 2006. Their payment jumped from $820 to $1,400. They tried to refinance, but their home value had started dropping. The equity they thought they had was evaporating. They fell behind, one payment, then two. They weren't alone. April 2007, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. August 2007, Two Bear Stearns hedge funds collapsed because their subprime bonds became impossible to value. March 28. Bear Stearns itself sold to JP Morgan for $2 per share. A year earlier, it traded at $107. September 28. Lehman Brothers filed for bankruptcy. The fourth largest investment bank in America, gone. That same month, the government seized Fannie Mae and Freddie Mac. These two entities owned or guaranteed half of all U.S. mortgages, $12 trillion in exposure. Stage 4, the avalanche. Foreclosure filings hit levels never seen before. In 2010, nearly 2.9 million properties received foreclosure notices. Entire neighborhoods in Las Vegas, Phoenix, Miami, and California's Central Valley emptied out. Home prices fell 27% nationally from peak to bottom. In Nevada, they dropped 62%. In Florida, 56%. In Arizona, 51%. David and Rachel tried to sell their home in 2009. The best offer was $140,000. After realtor fees and closing costs, they would have needed to bring $30,000 to the table just to get out, money they didn't have. They walked away. Short sale. Their credit destroyed for years. 9 million American families lost their homes. Unemployment hit 10%. The stock market fell 57% from peak to trough. Retirement accounts were gutted. $16 trillion in household wealth vanished. But that wasn't even the worst part. The worst part was who got help and who didn't. Who? Banks received $700 billion through TARP. AIG got $182 billion. The government created the Home Affordable Modification Program to help homeowners. It was supposed to assist 3 to 4 million families. It helped fewer than a million. Most of those modifications failed within a few years anyway. By 2012, Wall Street had recovered. American households didn't regain their lost wealth until 2016. An entire generation learned not to trust the system. Now here's what matters for you today. In 2008, the crisis started at the bottom of the market. Subprime borrowers who never should have qualified. Bad loans to bad credit risks. This time, it's different. Not better. Different. The stress isn't coming from subprime. It's coming from the middle. Teachers, nurses, electricians, people with 680 credit scores who did everything right. They bought homes they could afford at rates they could manage. Then every cost around that mortgage increased 30 to 50% while their paychecks stayed flat. Same pattern, different mechanism, same result. Let me show you exactly where we are in the cycle right now. Now let me map this pattern to what's happening right now. Because we didn't learn from 2008. We did the exact same thing again, only bigger. After the financial crisis, the Federal Reserve dropped interest rates to near zero. December 2008, the federal funds rate hit 0.25%. Essentially free money for banks. The idea was simple. Cheap borrowing would stimulate the economy, get people spending again, get businesses hiring again. It worked, eventually. But here's what nobody planned for. The Fed kept rates at or near zero for 13 years. Think about that. 13 years of the cheapest borrowing costs in American history. An entire generation came of age thinking 3 and 4% mortgages were normal. They weren't. They were a historic anomaly created by extraordinary policy intervention. Between 2008 and 2021, you could get a 30-year fixed mortgage for under 4% almost any time you wanted. Rates dipped below 3.5% multiple times. The money just kept flowing. Then came 2020, the pandemic hit, the economy shut down, the Fed panicked. They slashed rates back to zero and started buying mortgage-backed securities by the hundreds of billions. They were pumping liquidity into the system like never before. Mortgage rates collapsed. In January 2021, the average 30-year fixed rate hit 2.65%, the lowest ever recorded. You could borrow $400,000 and pay less per month than someone who borrowed $250,000 in 1995. The mortgage industry went into overdrive. In 2020, lenders originated $4.5 trillion in new mortgages. In 2021, they did it again. Back-to-back years of record volume. People bought homes. People refinanced. People pulled cash out of their equity. Everyone was taking advantage of free money. Let me show you what this created. In 2009, after the crisis, total U.S. mortgage debt stood at $10.3 trillion. By the third quarter of 2025, it reached $13.07 trillion. That's a $2.77 trillion increase in mortgage debt. But the raw number isn't what matters. The composition matters. In 2009, most of that debt was legacy, loans from before the crisis, loans that were slowly being paid down or written off through foreclosure. By 2025, a huge portion of the debt represents loans originated between 2020 and 2022. Peak prices, peak leverage, borrowers stretched to afford homes in the most competitive market in history. Here's the data that should concern you. According to Federal Reserve figures, the average mortgage balance rose from $207,000 in late 2019 to over $250,000 by 2024. That's a 21% increase in average loan size in just 5 years. People weren't borrowing more because houses got bigger. Square footage barely changed. They borrowed more because prices exploded and cheap rates let them stretch further than they should have. Meanwhile, total household debt hit a record $18.59 trillion by the third quarter of 2025. Mortgages make up $13.07 trillion of that. But there's another $1.66 trillion in auto loans, another $1.23 trillion in credit cards, another $1.65 trillion in student loans. The average American household is more leveraged than at any point in history, and it gets worse. Home equity lines of credit started climbing again. In early 2022, Americans owed $317 billion on HELOCs. By the first quarter of 2025, that number reached $422 billion, a 33% jump in 3 years. The average HELOC balance hit $45,150 in 2024. In expensive markets like California, New York, and Massachusetts, average balances exceeded $70,000. These aren't mortgages. They're variable rate credit lines secured against your home. When rates were low, the payments were easy. A $50,000 HELOC at 3.25% prime costs you about $135 a month in interest. But HELOC rates float with the prime rate, and the prime rate follows the Fed. When the Fed raises rates, your HELOC payment rises with it. We'll come back to what happened with those payments in a few minutes. First, let me show you stage 2, the equity illusion. Because what happened to home prices between 2020 and 2022 was unlike anything in American history outside the years leading up to the Great Depression. Stage 2 is when people start feeling rich, home values climb, equity builds, banks tell you that you're sitting on a gold mine, everyone around you is cashing in, you'd be foolish not to join them. That's the trap. Because equity in your home isn't wealth, it's potential, and potential only becomes real if you sell or if you borrow against it. One means moving, the other means more debt. Between 2020 and 2022, Americans chose debt. Let me show you what happened to prices. In March 2020, when the pandemic lockdowns began, the median U.S. home price was $287,000. By March 2025, that median hit $437,000. That's a 41% increase in 5 years. In dollar terms, the typical American home gained $116,700 in value. But in hot markets, the gains were even more extreme. Phoenix, up 45%. Austin, up 48%. Boise, up 52%. Miami, up 36%. Tampa, Nashville, Salt Lake City, all posted gains above 40%. If you owned a home in any of these markets before 2020, you woke up one day and the number on your Zillow estimate had jumped by 6 figures. People who bought in 2015 or 2018 suddenly had $200,000, $300,000, even $400,000 in paper equity. The financial industry noticed. Your mailbox filled with offers, home equity lines of credit, cash out refinancing, debt consolidation loans secured by your property. Banks were practically begging you to tap your equity, and people did. HELOC originations surged. Total home equity line balances grew from $317 billion in early 2022 to $422 billion by early 2025. That's $105 billion new borrowing against home equity in just 3 years. The average HELOC balance reached $45,150 by 2024. In California, it exceeded $70,000. What did people use the money for? Renovations? New kitchens? Backyard pools? The home improvement industry boomed. Debt consolidation? Paying off credit cards with a lower rate home equity line seemed smart, except now that debt was secured by your house. Investments. Some people used HELOC funds to buy rental properties or invest in the stock market, leverage on top of leverage, living expenses. As inflation spiked in 2022 and 2023, some homeowners used equity just to cover the gap between income and rising costs. Here's what most people didn't understand. That equity wasn't real wealth. It was a number on a screen. The only way to access it was to take on more debt. And debt secured by your home carries a specific risk. If you can't pay, you lose the house. Let me introduce you to a couple. Call them James and Keisha. In April 2021, they bought a home in the Phoenix suburbs. $385,000. They put down 5%, about $19,000. Their combined income was $95,000 a year. They locked in a 30-year fixed mortgage at 3.1%. Monthly payment, including taxes and insurance, came to about $1,850. That's 23% of their gross income, comfortable by any standard metric. By early 2023, their home appraised at $510,000. On paper, they had gained $125,000 in equity after just 2 years. Their lender sent an offer, a $60,000 home equity line of credit, pre-approved, low introductory rate. They took $45,000 of it, new HVAC system, kitchen update, paid off 2 car loans. Their total housing debt went from $366,000 to $411,000. But their home was worth $10,000. They still had over $100,000 in equity. The numbers worked. On paper, their HELOC rate was variable, tied to the prime rate. At the time they opened it, prime was 3.25%. Their HELOC rate was prime plus 1%, so 4.25%. On $45,000, that's about $159 a month in interest. Add that to their mortgage payment. Total housing cost, around $2,000 a month. Still manageable, still under 25% of gross income. James and Keisha did everything by the book. Good credit scores, stable jobs, reasonable debt-to-income ratio. They weren't speculators. They weren't flippers. They were a middle-class couple who bought a home and made what seemed like sensible financial decisions. They had no idea what was coming. Because stage 2 always feels like prosperity. You feel smart. You feel like you're building wealth. Everyone around you is doing the same thing. The problem is that stage 2 is built on 2 assumptions. First, that prices will keep rising, or at least hold steady. Second, that borrowing costs will stay low. When both assumptions break at the same time, stage 2 equity becomes stage 3 devastation. That's exactly what happened starting in March 2022. Stage 3 is where the trap closes. It doesn't happen all at once. It's not a single event. It's a cascade. One cost increase leads to another, each one manageable on its own. Together, they become crushing. Let me walk you through exactly what happened. March 2022. The Federal Reserve raised interest rates for the first time since 2018, a quarter-point increase, the first of 11 hikes over the next 16 months. By July 2023, the federal funds rate hit 5.33%, up from near zero just 18 months earlier. The fastest rate hiking cycle in 4 decades. Mortgage rates responded immediately. In January 2022, the average 30-year fixed rate was around 3.4%. By October 2023, it hit 7.79%, the highest since 2000. Let me put that in real numbers. At 3%, a $400,000 mortgage costs you $686 per month in principal and interest. At 7%, that same $400,000 mortgage costs $2,761 per month. That's $975 more every single month. Nearly $12,000 more per year. For the exact same house, new buyers got crushed, affordability collapsed. But here's what most people miss. Existing homeowners with fixed-rate mortgages weren't directly affected by mortgage rate increases. Their rate was locked. Their payments stayed the same. So why are delinquencies rising? Because the mortgage payment is only part of your housing cost, and everything else exploded. Let's start with homeowners insurance. This is the crisis nobody saw coming. Nationally, insurance premiums have increased 30 to 40% over the past 5 years. Florida. The average homeowner's insurance premium is now $7,130 per year, according to some estimates. Other projections put it closer to $11,000 or even $15,660 depending on location and coverage level. That's up from around $2,500 just 5 years ago. Some Florida homeowners report premiums hitting $10,000 to $12,000 annually for the same coverage they had before. California. After years of devastating wildfires, insurers started fleeing the state. State Farm stopped writing new policies entirely. Homeowners in fire zones are being pushed onto the state's FAIR plan, which costs 2 to 3 times more than traditional coverage and provides less protection. Insurify projects. California home insurance will rise 21% in 2025 alone following the Los Angeles fires. Louisiana. Premiums jumped 38% in 2024. Projections for 2025 show another 27% increase. The average is heading toward $14,000 annually. Nebraska, Oklahoma, Kansas, Texas. Tornado and hail damage are pushing premiums into the $5,000 to $7,000 range. Between 2018 and 2023, insurers canceled nearly 2 million homeowners policies nationwide. They simply refused to cover homes in areas they deemed too risky. Homeowners who lost coverage had to scramble for alternatives, often paying double or triple what they paid before. According to ICE mortgage technology data, single-family homeowners with a mortgage now pay an average of $2,270 per year for property coverage. That's up nearly 70% from 5 years ago, 70%. Now let's talk about property taxes. When your home value increases, your county assessor eventually notices. Reassessments lag behind market prices, but they catch up. A home valued at $300,000 for tax purposes in 2020 might be assessed at $450,000 by 2024. In Texas, where property taxes fund most public services, some homeowners saw tax increases of 30 to 40% between 2020 and 2024. On a $400,000 home, that's an extra $3,000 to $4,000 per year. These increases hit your escrow account. Most homeowners pay property taxes and insurance through escrow, bundled into their monthly mortgage payment. When taxes and insurance rise, your lender sends you a letter. Your escrow is short. Pay the difference immediately or your monthly payment increases. Remember Marcus from the beginning of this video? That's exactly what happened to him. His insurance doubled, his taxes increased. Suddenly, his lender wanted an extra $387 per month. No warning, no choice. Now let's talk about variable rate debt. Home equity lines of credit are tied to the prime rate. Prime follows the federal funds rate. When the Fed raised rates from near zero to 5.33%, prime went from 3.25% to 8.5%. On a $50,000 HELOC at prime plus 1%, your interest rate went from 4.25% to 9.5%. Monthly interest payment at 4.25%, about $177. Monthly interest payment at 9.5%, about $396. That's $219 more per month. $2,628 more per year, just in interest. On a single line of credit, multiply this across 13.1 million HELOC accounts totaling $402 billion. Millions of households saw their variable rate payments more than double. Now let's go back to James and Keisha. Remember their situation. $385,000 home purchased in 2021. 3.1% fixed rate mortgage, $45,000 HELOC opened in 2023 at prime plus 1%. Their original housing cost was around $2,000 per month. Here's what happened. Their HELOC payment jumped from $159 per month to $396 per month, plus $237. Their homeowners insurance increased from $1,400 annually to $2,800, plus $117 per month. Their property taxes rose from $40,200 to $5,600 annually as the county reassessed, plus $107 per month. Their mortgage payment stayed the same, $1,850. New total monthly housing cost, $2,850. That's an $850 increase on the same house, with the same fixed rate mortgage, without buying anything, without making any new financial decisions. Their housing cost went from 23% of gross income to 36%. They're still employed, still making the same money, still doing everything right. But they went from comfortable to struggling in 18 months. And here's the part that should terrify you. James and Keisha can still make their payments. Barely. They've cut back on everything else. No vacations, no retirement contributions, no emergency fund growth. They're one car repair away from trouble, one medical bill, one layoff. Millions of American families are in exactly this position right now. The data proves it. In the third quarter of 2025, the Mortgage Bankers Association reported the national delinquency rate at 3.99%, up 7 basis points from the prior year. By November 2025, ICE Mortgage Technology reported the rate hit 3.85%, with 2.3 million homes in some stage of delinquency. In a single month, 275,000 borrowers who had been current fell behind, the largest one-month spike since May 2020. But the national average hides where the real stress is concentrated. FHA loans. These are mortgages backed by the Federal Housing Administration, typically first-time buyers. Lower down payments, moderate incomes, teachers, nurses, police officers, working families. FHA delinquency rates hit 9.7% in the third quarter of 2025. Nearly 1 in 10 FHA borrowers is behind on payments. That's up 50 basis points from the prior year. FHA mortgages account for less than 15% of all active mortgages, but they represent 90% of the year-over-year increase in delinquencies. The middle class is cracking. VA loans, mortgages for veterans. Delinquency rates reached 4.8%, the highest since 2020. Geographic concentration is stark. The states with the largest delinquency increases are Florida, South Carolina, Georgia, Arizona, and Nevada. Notice a pattern? These are Sunbelt states that saw massive population influxes during the pandemic. Prices soared. Construction boomed. Now costs are catching up with incomes. Mississippi and Louisiana have the worst overall delinquency rates in the country. Louisiana is reporting mortgage non-current rates around 7.5%. These states face significantly higher financial stress than the national average. Marina Walsh, Vice President of Industry Analysis at the Mortgage Bankers Association, identified the stressors directly. A softer labor market, other personal debt obligations, increases in taxes, homeowners insurance, and other fees that exacerbate already stretched affordability. This is stage 3. Not a crash, not a collapse, a slow suffocation, death by 1,000 cuts. The question now is whether it stays at stage 3 or tips into stage 4. Let me show you the warning signs. Stage 4 doesn't announce itself. There's no single moment when the market tips from stress to crisis. No bell rings. No headline screams that the avalanche has started. Instead, you see indicators. Small shifts in data that most people ignore, until they can't ignore them anymore. Right now, in January 2026, those indicators are flashing. Let me show you what I'm seeing. First, foreclosures are accelerating. According to Atom, foreclosure filings hit 460 properties in 2025. That's up 14% from 2024, up 3% from 2023, the highest level since 2019. In December 2025 alone, 44 out of 990 properties received foreclosure filings. That's up 26% from November and up 57% from December 2024. Foreclosure starts, meaning properties entering the foreclosure process for the first time, reached 289,441 in 2025, up 14% from the prior year, up 213% from the pandemic era low in 2021. Now I need to give you context. These numbers are still far below crisis levels. In 2010, at the peak of the last collapse, nearly 2.9 million properties received foreclosure filings. We're at a fraction of that, but direction matters more than absolute levels. Every major crisis starts with numbers that look manageable. It's the trend that kills you, and the trend is accelerating. In the fourth quarter of 2025, foreclosure activity spiked. Total filings hit 111,692 properties, up 10% from the previous quarter and up 32% from a year earlier. Foreclosure starts in December 2025 rose 19% from November and 46% from the prior year. Completed foreclosures, where the bank actually repossesses the property, more than doubled compared to December 2024. Rob Barber, CEO of Adam, called it a continued normalization of the housing market. That's one way to describe it. Another way is to say the floor is crumbling faster than anyone expected. Second, look at where foreclosures are concentrated. This isn't a national crisis. Not yet. It's regional. And the regions in trouble are exactly the ones that saw the biggest gains during the pandemic boom. Florida leads the nation with the highest foreclosure rate in 2025. Filings hit 0.44% of all housing units. 1 in every 230 homes. That's up from 0.37% in 2024. Within Florida, the hotspots are brutal. Lakeland, 1 in every 145 housing units with a foreclosure filing, the worst rate of any major metro area in America. Cape Coral, 1 in every 189 housing units. Jacksonville, 1 in every 200 housing units. Orlando, Tampa, Palm Bay, all posting rates double the national average. Florida's housing market boomed harder than almost anywhere during the pandemic. Remote workers flooded in, prices soared, construction exploded, now insurance costs have tripled, property taxes have surged, and the buyers who stretched to get in are starting to break. Hannah Jones, senior economic research analyst at Realtor.com, explained it directly. Growing home supply has softened demand, slower price growth, longer time on market. These dynamics increase foreclosure risk for homeowners who bought near the peak or carry higher monthly costs. But Florida isn't alone. South Carolina, foreclosure rate of 0.41%. Columbia, the state capital, posted 1 in every 165 housing units with a filing. Illinois, 0.40% rate. Chicago at 1 in every 263 housing units. Delaware, 0.42%. Nevada, 0.38%. Las Vegas at 1 in every 250 housing units. New Jersey had the highest foreclosure rate of any state in December 2025. 1 in every 1,734 housing units with a filing that month alone. Atlantic City posted 1 in every 192 housing units for the full year. These aren't random locations. They're either pandemic boom towns where prices outran fundamentals, or legacy markets with older housing stock and stagnant incomes. Third, homes are sitting longer. When a housing market is healthy, homes sell quickly. Buyers compete. Listings disappear in days. When a market weakens, homes sit. Days on market stretch. Sellers get nervous. Price cuts follow. In October 2025, the median home sat on the market for 60 days nationally. That's up from the prior year. It's been climbing for over 20 consecutive months. In some markets, the slowdown is more severe. Parts of Texas, parts of Florida, parts of Arizona. Homes that would have sold in a weekend during 2021 now sit for 2 or 3 months. Why does this matter? Because time on market is a leading indicator. When homes sit longer, sellers get desperate. Desperate sellers cut prices. Price cuts create comparable sales that lower appraisals. Lower appraisals make financing harder. Harder financing means fewer buyers. Fewer buyers means homes sit even longer. The feedback loop has started. Fourth, some homeowners are already underwater. This is the statistic that should keep you up at night. According to estimates, approximately 4 to 5% of homeowners who purchased between 2021 and 2023 would lose money if they tried to sell today after accounting for closing costs and realtor fees. Not underwater on their mortgage alone, underwater after the 6% it costs to sell a home. In dollar terms, that's roughly 2 to 3 million homeowners who are functionally trapped. If they need to move, they can't sell without bringing cash to closing. If they lose a job, if they get divorced, if they have a medical emergency, they have no exit. These homeowners did nothing wrong. They bought at the wrong time. They're stuck. History shows that when negative equity reaches 5 to 7% of homeowners, psychology shifts. People start making different decisions. Strategic defaults increase. Walking away becomes rational. We're approaching that threshold. Fifth, the canaries are dying. In any market stress, certain borrowers break first. They're the early warning system. The canaries in the coal mine, right now, that's FHA and VA borrowers. FHA loans serve first-time buyers, lower-income households, buyers with smaller down payments. These are middle-class families on tight margins. When costs increase, they feel it immediately. FHA delinquency rates hit 9.7% in the third quarter of 2025. Nearly 1 in 10 FHA borrowers is behind. The seriously delinquent rate, loans 90 or more days past due, jumped 50 basis points year over year. FHA loans represent less than 15% of all active mortgages, but they account for 90% of the year-over-year rise in total delinquencies. The stress isn't spread evenly. It's concentrated at the bottom of the income ladder and working its way up. VA loans are following the same pattern. After a year-long foreclosure moratorium ended in late 2024, VA foreclosure activity resumed. The VA foreclosure inventory rate hit 0.84% in early 2025, the highest since late 2019. Tens of thousands of VA loans that had been in forbearance entered foreclosure proceedings. These foreclosures will hit the market throughout 2026, adding supply at exactly the wrong time. Donna Schmidt, president and CEO of DLS Servicing, identified the problem directly. The share of FHA borrowers who have had a previous partial claim rose from 5% in 2020 to 50% in 2025. Half of struggling FHA borrowers have already used their safety net once. They have nothing left. Diminished home equity and reliance on down payment assistance leave many FHA borrowers particularly vulnerable. Under current conditions, distressed borrowers may be unable to qualify for additional loss mitigation. Translation: the people who are breaking first have no cushion and no way out. Sixth, the wild card nobody's discussing: commercial real estate. Office buildings are in crisis. Work from home decimated demand. Vacancy rates in major cities range from 20 to 30%. Valuations have dropped 30 to 50% from pre-pandemic peaks. Why does this matter for homeowners? Because regional banks hold massive commercial real estate loan portfolios. These loans are coming due for refinancing through 2026 and 2027. Many CA can't be refinanced at current values. Banks will take losses. We already saw what happens when regional banks fail. Silicon Valley Bank, Signature Bank, First Republic, all collapsed in 2023. If enough regional banks take commercial real estate losses, credit tightens. Banks that survive become ultra-conservative. Lending freezes. No lending means no housing transactions. No transactions means price discovery stops. When price discovery resumes, it's usually at lower levels. The 2008 crisis started in housing and was amplified by banking system fragility. The same dynamic could play out in reverse this time. Commercial real estate stress bleeds into regional banks. Regional bank stress bleeds into housing credit. Housing credit constraints trigger more distressed sales. So where does this leave us? We're not in stage 4 yet. We're in the transition zone. Stage 3 bleeding into stage 4 in specific markets and specific borrower segments. Foreclosures rising but not exploding. Prices flat but not crashing. Delinquencies climbing but not spiking. The avalanche hasn't fully started, but the snowpack is unstable. One good push and it breaks loose. That push could be a recession, rising unemployment, a stock market crash, a commercial real estate banking crisis, or it could just be 18 more months of cost increases grinding down household balance sheets. Either way, the ingredients are present. Now let me address what the optimists are saying, because you've probably heard the counter-arguments, and some of them have merit. I can hear you thinking, this time is different. We learned from 2008. The system is stronger now. You've probably heard the counter-arguments on financial news from your realtor, from that friend who works in banking. They're not entirely wrong, but they're not entirely right either. Let me address each objection directly. Objection 1. Lending standards are stronger now. This is true. After 2008, regulators overhauled the mortgage industry. The Dodd-Frank Act created new rules. The Consumer Financial Protection Bureau started policing lenders. Underwriting standards tightened dramatically. The numbers reflect this. In the mid-2000s, the average credit score for mortgage originations was around 650 to 680. Subprime borrowers with scores below 620 represented 20% of new loans. Today, the average FICO score for mortgage originations is around 730. Subprime represents only about 4% of new loans. Down payments are higher. Income verification is stricter. Debt-to-income requirements are enforced. The ninja loans are gone. No more no income, no job, no asset approvals. Lenders actually verify that borrowers can pay. So the optimists have a point. We're not repeating the exact mistakes of 2008, but here's what they're missing. Strong lending standards don't prevent crisis. They change how the crisis manifests. In 2008, the problem started at the bottom. Unqualified borrowers who never should have gotten loans, bad credit, no down payments, predatory terms. When the market turned, they defaulted immediately because they never had the capacity to pay in the first place. This time, the stress is coming from the middle. Look at FHA loans. These aren't subprime. FHA borrowers have average credit scores around 680. They put down 3.5 to 10%. They verify income. They qualify under standard debt-to-income ratios. These are middle-class families, teachers, nurses, electricians, first responders. Their delinquency rate hit 9.7% in the third quarter of 2025. Why? Because even with good credit and stable jobs, they're stretched thin. One unexpected expense and they can't recover. The 2008 crisis came from lending to people who couldn't afford homes. This crisis comes from people who could afford homes until every cost around that home increased 30 to 50% after they bought it. Same destination, different route. Strong underwriting means borrowers had capacity when they signed the loan. It doesn't mean they have capacity 3 years later when insurance has doubled, property taxes have jumped, and their HELOC payment has tripled. The lending standards argument assumes static conditions. Conditions aren't static. Objection 2. Homeowners have equity. This is the argument you hear most often. And superficially, it's compelling. American homeowners hold approximately $35.8 trillion in home equity as of mid-2025. That's a staggering number, the highest ever recorded. The logic goes like this. Even if prices fall 20%, most homeowners would still have equity. They could sell and walk away with something. They're not trapped, like in 2008. 3 problems with this argument. First, that equity is concentrated. The $35.8 trillion isn't spread evenly across 86 million mortgages. It's heavily concentrated among homeowners who bought before 2019. If you purchased a home in 2010, 2012, or even 2015, you're sitting on massive gains. You bought at post-crisis lows. You've had a decade or more of appreciation. Your mortgage balance is paid down. You have real equity. But if you bought in 2021 or 2022 at the peak with a small down payment, your situation is completely different. Home prices have flattened or declined slightly in many markets. Closing costs and realtor fees eat 6 to 8% of sale price. An estimated 4 to 5% of homeowners who bought between 2021 and 2023 would lose money if they sold today after transaction costs. Aggregate equity statistics hide this distribution problem. The people with equity don't need to sell. The people who need to sell often don't have equity. Second, equity only matters if you can access it. That $35.8 trillion is theoretical. It exists on paper. To turn it into actual money, you have 2 options. Option 1, sell the house and move somewhere cheaper, but where? If you're in a high-cost area, moving means uprooting your job, your kids' schools, your entire life. And if prices have fallen in your market, they've probably fallen in nearby markets too. Option 2, borrow against the equity. Take out a HELOC or cash out refinance. But that means adding more debt at current rates, which is exactly how people got into trouble in the first place. Equity you can't access isn't a safety net. It's a number on a statement. Third, equity can vanish fast. In the second quarter of 2006, American households held about $13 trillion in home equity. By the first quarter of 2009, that had fallen to $6 trillion. $7 trillion evaporated in less than 3 years. Price declines compound faster than people expect. A 10% drop doesn't reduce equity by 10%. It reduces equity by a much larger percentage because mortgage debt stays fixed. Simple math. You bought a $400,000 home with a $360,000 mortgage. Your equity is $40,000. Prices fall 15%. Your home is now worth $340,000. Your mortgage is still $360,000. You don't have $34,000 in equity. You have negative $20,000. You went from $40,000 positive to $20,000 underwater. A 15% price decline caused a 150% change in your equity position. The current $35.8 trillion in aggregate equity could become $28 trillion or $25 trillion with a 20 to 25% price correction. Suddenly, millions more homeowners are underwater. The equity buffer is real, but it's not as large as people think, and it can disappear faster than anyone expects. Objection 3. The Fed can cut rates. This is the ace people think the government holds. If things get bad, the Federal Reserve will slash rates. Mortgage rates will fall. Affordability will improve. The market will stabilize. History suggests otherwise. The Fed cut rates aggressively in 2008. They dropped the federal funds rate from 5.25% to 0.25% in just over a year. It helped eventually, but not before 9 million families lost their homes. Monetary policy works with long lags. Rate cuts take 12 to 18 months to fully transmit through the economy. By the time lower rates stimulate housing demand, stabilize prices, and restore confidence, the damage is already done. The Fed also faces a constraint it didn't face in 2008: inflation. In 2008, inflation was falling. The Fed could cut without worrying about price stability. They had room to act. Today, inflation remains sticky. The Fed spent 2022 and 2023 raising rates to fight it. They can't simply reverse course without risking a resurgence. If inflation stays elevated, the Fed can't cut aggressively. They're stuck between saving the housing market and controlling prices. History shows they'll prioritize controlling inflation. Paul Volcker did it in the early 1980s. It caused a brutal recession, but broke inflation's back. There's another problem. Even if the Fed drops rates to 0, mortgage rates won't return to 3%. The spread between Treasury yields and mortgage rates has widened. In normal times, 30-year mortgages price about 1.5 percentage points above the 10-year Treasury. Since 2022, that spread has expanded to 2 points or more. Why? Increased risk perception, volatility, uncertainty about prepayment behavior. Banks want more compensation for making 30-year loans. If the Fed cuts the funds rate to 0 and the 10-year Treasury falls to 2.5%, mortgage rates might reach 4.5 to 5%, not 3%, not 2.65%. That helps. But it doesn't solve the problem for homeowners already stretched at current costs, and it doesn't undo price declines that have already occurred. The Fed is powerful, but it's not omnipotent. Its tools work slowly, and this time it has less room to maneuver. So where does that leave us? The optimists aren't wrong about the facts. Lending standards are stronger. Equity levels are higher. The Fed has tools, but they're drawing the wrong conclusion. These factors don't prevent a crisis. They change its shape. They might make it slower. They might make it smaller in some dimensions, but they don't stop the fundamental dynamic. Costs have outpaced incomes. Debt levels are at record highs. Millions of homeowners are stretched to their limit. The margin for error is gone. Strong lending standards mean qualified borrowers are breaking instead of unqualified ones. High aggregate equity means the crisis is concentrated among recent buyers instead of spread evenly. The Fed's constraints mean intervention will be slower and less effective. Different doesn't mean better, it just means different. The question isn't whether there will be pain. There will be. The question is how much and how fast. Let me show you the 3 scenarios I see playing out over the next 18 months. Nobody knows exactly what happens next. Anyone who tells you they do is lying. The economy is too complex, too many variables, too many feedback loops, too many potential shocks that can't be predicted. But we can map out scenarios. We can identify the conditions that lead to each outcome, and we can assign rough probabilities based on current data. Here are the 3 paths I see. Scenario 1, soft landing. This is the optimistic case, the one the Federal Reserve is hoping for, the one most financial analysts are projecting. Here's how it plays out. Economic growth remains stable. GDP continues expanding at 2 to 2.5% annually. No recession. The labor market stays relatively healthy. Unemployment holds below 5%. Job losses stay concentrated in specific sectors rather than spreading broadly. Inflation continues moderating. The Fed gains confidence and cuts rates gradually through 2026. The federal funds rate drifts down toward 3 to 3.5% by late 2026 or early 2027. Mortgage rates follow. The 30-year fixed rate, currently around 6%, eases toward 5.5%, maybe touches 5% briefly. In this scenario, the housing market stabilizes without crashing. Delinquencies rise, but don't spike. They peak around 4.5 to 5% nationally, then level off. Foreclosures increase modestly, but stay well below 2010 levels. The system absorbs the stress. Home prices stay flat in most markets. Decline 5 to 10% in the most overheated areas, Austin, Phoenix, Boise, parts of Florida. But no broad collapse. The lock-in effect gradually fades. Homeowners with 3% mortgages start accepting that rates won't return to pandemic lows. Some decide to move anyway. Inventory normalizes. Transaction volume recovers slowly. Homeowners who bought at the peak in 2021 and 2022 are stuck but not ruined. They can't sell without loss, so they stay put. They make their payments. They wait for appreciation to bail them out. In 5 to 7 years, they're probably fine. This scenario requires several things to go right simultaneously. No recession, no major geopolitical shock, no commercial real estate banking crisis, no significant increase in unemployment, continued moderation in inflation, gradual Fed rate cuts. Probability, maybe 35 to 40%, possible but requires luck. Scenario 2, correction. This is the middle case, more painful than a soft landing but short of catastrophe. Here's how it unfolds. Economic growth slows meaningfully. GDP growth drops below 1%, possibly flirts with negative quarters. Not a deep recession, more of a pronounced slowdown. Unemployment rises to 5.5 to 6.5%. Layoffs spread beyond tech and finance into retail, healthcare, professional services. Job losses hit middle-income households. The labor market that's been supporting housing demand weakens. Inflation stays stickier than expected. The Fed can't cut as aggressively as markets hope. Rates come down, but slowly. Mortgage rates remain in the 5.5 to 6.5% range through most of 2026. In this scenario, housing stress accelerates. Delinquencies rise to 5.5 to 6.5% nationally, approaching 2010 and 2011 levels. Foreclosure filings climb toward 500,000 or 600,000 annually, still below the 2.9 million peak of 2010, but painful nonetheless. Home prices decline 10 to 15% nationally. In the most overheated markets, drops reach 20 to 30%. Austin, a home that sold for $550,000 in 2022 might trade at $400,000 by late 2026. Phoenix, the $10,000 house James and Keisha bought drops to $380,000. They're deeply underwater. Parts of Florida, Cape Coral, Jacksonville, Tampa, price declines of 25% or more. Distressed sales increase, short sales return. Foreclosed properties hit the market, adding supply and pressuring prices further. The correction feeds on itself for 12 to 18 months before stabilizing. By late 2027 or early 2028, the market finds a bottom. But the damage is done. Homeowners who bought at the peak face real losses. Many are underwater. Some walk away. Credit scores crater. It takes years to recover. First-time buyers who waited on the sidelines start finding opportunities. Prices that seemed impossible become reachable. The market begins healing, but slowly. This scenario doesn't require anything dramatic. Just a moderate economic slowdown coinciding with the housing stress already building. No catastrophic shock needed, just gravity, probability, maybe 40 to 45%. The most likely outcome based on current data. Scenario 3, crisis. This is the worst case. Not as severe as 2008, but serious enough to reshape the housing market for a decade. Here's the path. A recession hits. Real recession. Not just slow growth. GDP contracts for 2 or more consecutive quarters. Unemployment spikes above 7%, possibly approaches 8%. The trigger could be anything. A commercial real estate collapse that takes down regional banks. Geopolitical shock, trade war escalation, financial system stress from an unexpected direction, or simply the accumulated weight of household debt finally breaking. Corporate layoffs accelerate. Consumer spending collapses. The wealth effect reverses hard. People who felt rich because of home equity now feel poor. They cut back on everything. The Fed responds, but too slowly. They're constrained by lingering inflation concerns. By the time they cut aggressively, the damage is spreading. In this scenario, housing enters a severe downturn. Delinquencies spike above 7 to 8%. Foreclosures explode toward 1 million or more annually. Still below 2010's 2.9 million, but devastating for the families involved. Home prices fall 20 to 30% nationally. In bubble markets, declines reach 40 to 50%. Neighborhoods that boomed during the pandemic become distressed. For sale signs multiply. Homes sit vacant. Maintenance deteriorates. The visual markers of decline that we saw in 2009 and 2010 return. Banks tighten lending standards dramatically. Even qualified buyers can't get mortgages. Transaction volume collapses. Price discovery becomes erratic. Appraisals come in low. Deals fall apart. The feedback loop goes into overdrive. Falling prices create more negative equity. Negative equity triggers more defaults. Defaults add more supply. More supply pushes prices lower. The cycle accelerates until it exhausts itself. Credit tightens across the economy, not just mortgages, auto loans, credit cards, business lending. The financial system hunkers down. Recovery takes years. The market doesn't bottom until 2028 or 2029. Full recovery to 2022 price levels might not happen until the early 2030s in some markets. Millions of families lose their homes. Generational wealth transfer reverses. Retirement plans derail. The social and economic scars persist for a decade. This scenario requires a significant external shock or a severe policy error. It's not the base case, but it's not impossible either. Probability, maybe 15 to 20%, low but not negligible. The wild card that could push scenario 2 into scenario 3. Commercial real estate. I mentioned this earlier, but let me be specific. Office buildings across America are in crisis. Remote work and hybrid arrangements decimated demand. Vacancy rates in major cities run 20 to 30%. In some submarkets, it's worse. These buildings were financed with loans that are now coming due. The typical commercial real estate loan term is 5 to 10 years. Loans originated in 2015 to 2020 are hitting refinancing walls right now. The math doesn't work. A building worth $100 million in 2019 might appraise at $60 million today. The owner owes $70 million. They can't refinance. They can't sell without taking a massive loss. They default. Regional banks hold enormous commercial real estate exposure. When these loans go bad, banks take losses. Enough losses. And banks fail. We already saw the preview in 2023. Silicon Valley Bank, Signature Bank, First Republic. All collapsed within weeks. The government intervened to prevent contagion. The next wave of commercial real estate distress hits through 2026 and 2027. If multiple regional banks fail, credit tightens across the board. Housing credit becomes scarce. The correction becomes a crisis. This is the scenario where dominoes start falling in unexpected directions. So what does this mean for you? If you're sitting there thinking you can predict which scenario plays out, you can't. Neither can I. Neither can the Federal Reserve. Neither can the smartest economists on Wall Street. What you can do is prepare for multiple outcomes. If scenario 1 happens, you lose nothing by being prepared. You just have more financial cushion than you needed. If scenario 2 happens, preparation is the difference between weathering the storm and getting swept away. If scenario 3 happens, preparation might be the difference between keeping your home and losing it. The downside of not preparing is catastrophic. The downside of preparing is zero. That calculation should be obvious. Let me show you exactly what to do. I've spent this entire video showing you the problem. Now let me show you what to do about it. These aren't generic tips. These are specific actions you can take in the next 30 days to position yourself for whatever comes. Whether we get a soft landing, a correction, or a crisis, these steps protect you. Action 1. Calculate your real housing cost. Most people know their mortgage payment. They have no idea what they actually spend on housing. Sit down this weekend. Pull out every statement, add it all up. Principal and interest, your base mortgage payment, property taxes. Take your annual bill and divide by 12. Homeowners insurance, annual premium divided by 12. HOA fees if applicable. HELOC or second mortgage payments. PMI if you're still paying private mortgage insurance. Average utilities, electric, gas, water, trash, maintenance reserve. Budget, 1% of your home's value annually, divide by 12. This isn't optional. Roofs fail. HVAC systems break, plumbing leaks. If you're not reserving for maintenance, you're lying to yourself about your housing cost. Add every line item, get one number. Now divide that number by your monthly gross income. What percentage is it? If you're below 28%, you have margin. You can absorb cost increases, you're in a strong position. If you're between 28 and 33%, you're in the caution zone. 1 or 2 cost increases and you're stretched. If you're between 33 and 40%, you're in the danger zone. You're one emergency away from trouble, one job loss away from crisis. If you're above 40%, you need to take action immediately. You're living on the edge. Something has to change. Most people have never done this calculation honestly. They know their mortgage payment. They don't know their total housing burden. Do the math. The number might surprise you. Action 2, build a dedicated housing emergency fund. You probably have an emergency fund, 3 to 6 months of expenses. Standard advice. But I want you to think about housing separately. Calculate 6 months of your total housing cost, that number you just calculated in action 1, multiply by 6. If your total housing cost is $2,500 per month, your housing emergency fund target is $15,000. This money sits in a separate account, high yield savings. Not invested, not touched for anything except housing emergencies. Why 6 months? Because if you lose your job or face income disruption, it takes an average of 4 to 6 months to recover. Longer if you're in a specialized field, longer if you're over 50, longer if the economy is weak. 6 months of housing costs means you can keep your mortgage current while you find new income. You won't fall behind. You won't start the slide toward delinquency. You won't panic sell into a weak market. If you don't have this cushion, make it a priority. Cut discretionary spending. Cancel subscriptions. Reduce dining out. Sell things you don't need. Pick up a side gig, whatever it takes. This fund is insurance. You're buying the ability to survive a shock without losing your home. The cost of building this fund is sacrificed today. The cost of not building it could be everything you own. Action 3, eliminate or fix variable rate debt. If you have a HELOC, an adjustable rate mortgage, or any debt tied to the prime rate, you need a plan. Variable rate debt is a ticking time bomb in a rising rate environment. Rates have stabilized recently but remain elevated. Prime is still around 8.5%. Your variable rate debt is expensive and could get more expensive. Option 1, pay it off. If you have liquid savings above your emergency fund, consider using it to eliminate variable rate debt. Yes, you're giving up potential investment returns, but you're buying certainty. You're removing a risk that could compound if conditions worsen. A guaranteed 9% return, which is effectively what you get by paying off 9% debt, is better than an uncertain 8% return in the stock market during a potential correction. Option 2, convert to fixed rate. Some lenders will let you convert a HELOC to a fixed rate home equity loan. The rate might be slightly higher than your current variable rate, but you lock in certainty. Your payment stays the same regardless of what the Fed does. Call your lender, ask about conversion options, get the terms in writing, do the math. Option 3, aggressively pay down the balance. If you can't pay off or convert, at least reduce the principal. Every dollar of principal you eliminate is a dollar that stops accruing interest. Make extra payments, throw any windfalls at the balance. The goal is to reduce your exposure to rate volatility. Variable rate debt magnifies both good times and bad times. In good times, low rates feel like free money. In bad times, the payment increases can break you. Remove the variable from your financial life. Action 4, stress test your situation. This is a mental exercise, but it might be the most important thing you do. Sit down with a calculator and run 3 scenarios. Scenario A, your housing costs increase 20%. Property taxes jump. Insurance premium spikes, maintenance emergency hits. Whatever the cause, your monthly housing burden goes up 20%. Can you handle it? Where does that money come from? What do you cut? How long can you sustain it? Scenario B, your home value drops 20%. Look up your current estimated value, multiply by 0.8. Now subtract your mortgage balance and any HELOC balance. Subtract another 6% for closing costs if you needed to sell. What's left? Are you underwater? If you had to sell tomorrow, would you owe money at closing? If the answer is yes, you need to know that now, not when you're forced to move. Scenario C, you or your spouse loses income. Pick the higher income in your household, eliminate it, add unemployment benefits, which typically replace 40 to 50% of wages up to a cap. Can you cover your housing costs for 6 months on the remaining income, plus unemployment, plus your emergency fund? If any of these scenarios breaks you, you have a vulnerability. You need to address it before the stress test becomes real. Reduce expenses, build savings, pay down debt, increase income, diversify income sources, whatever it takes to survive the scenarios you just imagined. The time to find your weak points is now, not when the market forces you to discover them. Action 5. If you're buying, be extremely selective. If you're planning to purchase a home in 2026, this section is for you. This is not a market for aggressive buying. This is a market for patience and precision. First, avoid the riskiest markets. Cities that saw 40% or more price increases since 2020 carry elevated correction risk. Austin, Phoenix, Boise, parts of Florida, Nashville, Salt Lake City, Tampa. I'm not saying don't buy in these places. I'm saying go in with eyes wide open. Run the numbers, assuming prices fall 20 to 25% over the next 2 years. Can you still afford the payment? Would you still want the house at that price? Are you planning to stay 7 to 10 years minimum? If the answer to any of those questions is no, reconsider. Second, don't stretch on price. The temptation is to buy at the top of your approval range. Banks will lend you more than you should borrow. They always do. Buy below your maximum. Leave margin for cost increases. Leave margin for rate increases if you need to refinance later. Leave margin for life surprises. A house that stretches you today will break you if costs rise 20% tomorrow. Third, if you can wait, consider waiting. Most housing forecasts project modest price growth of 2 to 4% in 2026 nationally, but some markets are projected to decline. More inventory is hitting the market. Days on market are increasing. Sellers are becoming more negotiable. If scenario 2 or scenario 3 unfolds, prices in overheated markets could drop 15 to 30% over the next 2 years. Buying at the peak of a market that's about to correct is how people got trapped in 2007 and 2008. Don't repeat their mistake. This doesn't mean never buy. It means be strategic, be patient, be willing to walk away from deals that don't make sense. Cash will be king if the market softens. Save aggressively, improve your credit score. Get pre-approved so you can move quickly when the right opportunity appears. The contrarian opportunity. Let me add one more thought for those in a strong financial position. If you have cash reserves, stable income, and no housing stress, market corrections create opportunities. In 2010, 2011, and 2012, investors bought foreclosed properties at 50 cents on the dollar. They built generational wealth while others were losing everything. That opportunity may return. If scenario 2 or scenario 3 plays out, distressed properties will hit the market. Short sales, foreclosure auctions, bank-owned properties. Prices will drop. Sellers will be desperate. If you're positioned with cash and patience, you can acquire assets at significant discounts. But this strategy requires genuine financial strength. You need cash reserves beyond your emergency fund. You need stable income you're confident won't disappear. You need the ability to hold properties through a potentially extended downturn. Don't try to catch a falling knife with borrowed money. That's how you become the next distressed seller. But if you're truly secure, start educating yourself now. Learn how foreclosure auctions work in your state. Understand short sale processes. Build relationships with real estate agents who specialize in distressed properties. When opportunity arrives, it moves fast. The prepared win. Everyone else watches. Let me bring this together. The pattern is clear. Cheap money, equity illusion, cost shock, avalanche. We've seen it before. We're seeing it again. We're not in stage 4 yet, but we're deep in stage 3 and the warning signs are multiplying. You can't control what happens to the economy. You can't control Fed policy. You can't control insurance premiums or property taxes or home prices, but you can control your preparation. Calculate your real costs. Build your emergency fund. Eliminate variable rate risk. Stress test your situation. Be strategic if you're buying. These actions cost you nothing except time and discipline. Not taking them could cost you everything. The storm is forming. You can see it on the horizon. The question is whether you'll be inside when it hits. Let me bring this full circle. At the beginning of this video, I told you about Marcus, a homeowner who did everything right, paid his bills on time, kept his job, made responsible decisions. Then his insurance doubled. His property taxes jumped. His escrow came up short. Suddenly, he owed an extra $387 per month that nobody warned him about. Marcus isn't a statistic. He's your neighbor, your coworker. Maybe he's you. Right now, 2.3 million American homeowners are behind on their mortgage payments. That number grew by 275,000 in a single month. The largest one-month spike since the economy shut down in 2020. Foreclosure filings are up 14% year over year. FHA delinquencies hit 9.7%. Nearly 1 in 10 working-class families with FHA loans is struggling to keep their home. Insurance costs have exploded 30 to 70% in 5 years. Property taxes followed home values higher. Variable rate debt payments have more than doubled. And we're just getting started. The pattern is clear. It happened in 1990. It happened in 2008. The same 4 stages. Cheap money, equity illusion, cost shock, avalanche. Every time people said it was different. Every time they were wrong. We're in stage 3 right now. The cost shock is here. The question is whether it stays contained or tips into stage 4. I've shown you the data. I've shown you the warning signs. I've shown you exactly where we are in the cycle. Now let me tell you what's coming next. I'm releasing part 2 of this series next week. In that video, I'm going to break down the specific markets most at risk of serious correction, city by city, state by state. I'll show you which metros have the worst foreclosure trajectories, which markets are seeing the fastest price declines, and which areas might actually hold up. I'll also walk through the foreclosure timeline in detail, how long the process takes in different states, when distressed inventory will hit the market, and the exact windows when buying opportunities are most likely to emerge. If you're thinking about buying, selling, or just protecting what you have, that information could save you tens of thousands of dollars. Hit subscribe right now so you don't miss it. Second thing, if this video added value, share it with someone who needs to hear it. You know someone who just bought a house at the peak, someone carrying a HELOC they haven't thought about in 2 years, someone who thinks their home equity makes them wealthy, a family member who's stretched thin and doesn't realize how close to the edge they are. This information could literally change their financial future. Send them the link, post it in your group chat, share it on social media. The people who survived 2008 weren't smarter. They weren't luckier. They were informed. They saw what was coming. They prepared. The people who got destroyed made simple mistakes. They bought more house than they could afford. They borrowed against equity to fund lifestyle. They assumed prices only go up. Right now, millions of Americans are making those same mistakes. They don't know what's coming. They haven't seen the data. Nobody's told them the pattern. You can change that for at least one person. Third thing, drop a comment below. Tell me what you're seeing in your market. Are prices holding or softening? Are homes sitting longer? Have you seen your insurance spike? Your property taxes jump? I want to know what's happening on the ground in your neighborhood. The national data tells one story. The local reality sometimes tells another. And tell me your biggest concern about the housing market right now. What keeps you up at night? What question do you want answered in part 2? I read every single comment. I respond to as many as I can. Your questions shape the content I create. Here's where we are. The ingredients for a housing correction are present. Delinquencies rising, foreclosures accelerating, costs outpacing incomes, household debt at record levels, millions of homeowners stretched to their limit. Will it become a full crisis? I don't know. Nobody does. But I know this. Preparation costs you nothing. A few hours calculating your real costs, a few months building an emergency fund, a few decisions to eliminate variable rate risk. Not preparing could cost you your home, your credit, years of wealth accumulation, everything you've worked for. The smart money is already positioning. They're building cash reserves. They're stress testing their finances. They're getting ready to buy when others are forced to sell. The question is which side of that trade you'll be on. The storm clouds are gathering. The wind is picking up. The pressure is dropping. You know what's coming. Get inside. Thanks for watching. I'll see you in the next one.